What's up, everybody? Michael and Coco here. You're watching episode 24 of the Weekly Scan.
The Weekly Scan.
The Weekly Scan is all about finding opportunities in the stock market for the weeks ahead. In today's episode, we're going to be using technical analysis to review 8 different stocks. And as for a quick disclaimer, these videos are for entertainment and educational purposes only. If you do not have experience investing, day trading, or swing trading individual equities, I would highly recommend you paper trading. For example, the link in the description below is to Webull, which offers an amazing paper trading platform. Webull recently reached out to me to become part of their influencer program. Yay! So if you sign up using that link below, you can get up to 2 free stocks, and Coco would get a free share as well. That's a happy face. One last thing before we hop into the computer, you're gonna hear me mention this time and time again, but risk management is the #1 key to success in these financial markets. Do not consider yourself an investor, a day trader, or a swing trader. Wipe that out of your mind and consider yourself a risk manager. You need to be very good at managing risk to be successful, especially when it comes to long-term success. Let's go ahead and hop into today's show. Welcome to the computer. We are now going to dive into the 8 charts on my watch list. Got some very interesting setups that I cannot wait to go over with you. We're going to be looking at support, resistance, and creating a trade plan for each of these stocks. These videos here are not recommendations. These are really just to help develop skills within creating trade plans and learning technical analysis. If you do not have experience, once again, please just watch these videos and learn from them before just entering into the stock market. The #1 thing that we need to focus on as traders and swing traders or investors is risk management. You're not a day trader, you're a manager of risk. You need to get into that mindset to be successful for the course of a lifetime. It's not about getting rich very quickly in a snap of the finger. It's about staying rich if you get there. I've said this before and I'll say it again. It's very easy to make money in the stock market. The hard part is keeping it. So when I talk about risk versus reward and go over stop losses, pay close attention to that because it is by far the most valuable information in any of my videos. All right, enough of that stuff. Let's just get into these charts. So the first ticker symbol we're looking at is ticker symbol FBK. And what I'm going to be doing going from here to the last chart is we're going to be looking at context first, then some indicators, and then create a trade plan around that. So without further ado, the context of this chart, FBK, it's somewhat undecided. And why do I say that? Well, we have the 50 period sloping upwards. That's bullish. We have the 200 period, the pink line or the red line, sloping downwards. So you have a Godfather moving average down, but you have another Godfather average moving up. So it's somewhat undecided. However, it's looking like the 200 is kind of getting evened out a little bit, still acting as a level of support and resistance. And then the 50 period is moving up towards it. If the 50 period crosses over the 200, that's known as a golden, which is known to be a bullish sign to create bullish sentiment in the market or in the individual equity. Okay, so the overall context, it's undecided looking at the moving averages. However, when we look at the current pattern, we saw this big run up and this consolidation take place right here. That is known as a bull flag. So that is bullish in this undecided type of context. The 200 period moving average clearly has data points right here, here, and here. So it acted as resistance, then support, and then support again. That is a good sign. Now, as far as indicators go, the RSI is showing that the stock is overbought, meaning that you can typically see it kind of move downwards from this point, eventually getting back into the 30 level or floating around the 50. It doesn't necessarily mean it's going to just come right back down. It could stay overbought for quite some time, but it is worth noting that the current stock is overbought. The MACD, very nice, bullish context. It's above 1 and it has a nice spread between the 2 lines here. It's picking up momentum, kind of died off just a little bit right here, but that's okay. It is overall in bullish context. Next is the volume. This right here is one big volume bar considering looking back through the history of the chart. Now, what I really like about this is we have such a very minute type of day with such large volume, which makes me pose the question, what's going on really right here? Now, with this type of volume and you have the candle, an indecision candle right here at a very prominent level of support, this looks like a setup that can really take off. But what I like most about this right now is the good risk versus reward setup that comes along with it. So how would I go about trading this? Well, first off, pay attention to the y-axis. Here on the daily time frame, it goes from $31 to $31.50. So a very tiny move like that will be 50 cents per share. So if you bought 500 shares of this and it moves just that much, that's $250. So do not get over leveraged on any one type of position because that can destroy a portfolio. Now this stock looks very similar to RUN, the other ticker symbol that we went over in a previous week that we saw a nice big run up with. That doesn't necessarily mean the same thing's going to happen, but it's worth pointing out. Now, what do I see here? Well, we have the 200 period moving average right here. That is clearly a level of support. It got held right there and right there. So what I would do for this specific trade, depending on where it opens, I would like to enter in anywhere between 29.10, which is at the 200 period moving average, all the way to, I would say, just above this high of the candle, or just below the high of this candle. Now, if it opens up on Monday up above this, then that'd be another story. We'd have to reassess and take a look, but that would be a bullish sign if we had a gap up, so we might be able to trade within that momentum. Somewhere around this range is a good entry point. You know, that'd be nice to have it below 30 right here, but a stop loss would be just right below the low of this candle. Somewhere probably, I would say 28.49 if you want to be very safe. Or you can just have it really at the low of this candle, which the low of that candle was at 28.85, so maybe 28.79. So where would a target be? Well, the target would be 31.50. I think that it'd be easy for the stock with this type of volume. If we do get a bump up and this is a bull flag and the pattern breaks to the upside, we can easily reach 31.50. Now, if it does reach 31.50, that does not necessarily mean I just exit the position completely. For example, if I were to buy 100 shares right here within this area, and I'd have a stop loss here, maybe the price goes like this and then moves up. Well, first off, I would look for this to be my target, okay? And then I would look for a risk mitigation point. The risk mitigation point would be right here at 30.50, maybe 30.49 just before, because it acted as resistance. So I'd be selling 33 shares here, and I'd be selling another 33 shares here at my target. So that means I would make money on the upside. And then if it breaks to the upside, I would let that remaining 33 shares work for me. That is how you manage risk successfully. You mitigate some shares, you hit your target, you sell a little bit more, and then you let the remainder work for you. And then during this process, you would be moving your stop loss up. I would not have my stop loss down here if the price was all the way up here. What I'd be doing is I would follow the candles up. So for example, if we were bought in right here, I would move my stop loss to this candle, the low of it, and then I'd move the stop loss to the low of this candle, then the stop loss to the low of this candle, then the stop loss to the low of this candle, and then I would have got stopped out right there for a move from $25 all the way up to $29.50-ish. This stock did show up on the dark money scan, so if you haven't watched the dark money scan, I show you how to find these specific type of setups on that video. I'll put the link in the description. Let's go ahead and move to the next one. This is ticker symbol TFFP. The overall context of this chart is bullish. Why is it bullish? We have the 200 right here, kind of going sideways, but slowly sloping up. We have the 50 period nicely sloping up. We have the context of the chart kind of nicely sloping up as well, the price action. Now, does this mean I would just enter into the trade? No, that does not mean I'll just enter into the trade because everything's bullish. Then you have to look at the price action. And what we have here is a significant gap and trap. What's a gap and trap? It means we had a huge gap up. A lot of people were probably very excited. And then the price ran up all the way just past $13, trapping in some long positions up here. We like to call those FOMO buyers. And then from that point, from a high of 13.18, it crashed all the way back down and closed at $11.55. Now this stock is overbought on the RSI. The MACD does show that it's bullish. It's above 1, nice bullish spread between the two. And we have some really big volume accumulation taking place. So how would I go about trading this stock? There'd be a couple of ways I'd do it. One, I would just be setting alert on my brokerage software saying that if the price can pull back to $10.52 or 51 cents, I would then place a trade in with a very tight risk versus reward setup. So this is what's known as a gap fill. When gaps are filled, typically you can see bounce points take place from the fill marker. So if you get filled from $10.51, you can potentially see it bounce from that point. Now there's a lot of volume accumulating, so this would make for a really good risk versus reward setup. So what would I do? Okay, so 10.51 would be my entry, and my stop loss would be 10.47, maybe even less. Why would I just have a 3-cent like move on this type of move? Well, one, I don't like risking a lot, so I'd be risking 3 cents to potentially see it bounce up to 11.50, probably very simple. So risking 3 cents to earn a lot more, very quick trade. I like the looks of that. However, if it breaks below this 10.50, it can easily head to $10. As you can see, there's 3 candles here, 1, 2, 3, that have strong support or resistance, at that $10. So if you get stopped out and lose 3 cents per share here, I would then be looking at $10.01 for a new entry point, and then a stop loss at $9.98 for a potential bounce from this point and a move higher. If that 3 cents gets beat up and destroyed, or if I get stopped out, I would have then lost about 6 cents per share, but still managed to see some potentially good upside potential. The next level would be right here at 9.50. So if you get stopped out on this trade, you can then go to 9.51 as an entry point and then have a stop loss at 9.48 or 9.49 or 9.47 and potentially see a bounce from that point. So there's 3 different trade setups right here. You can play the gap, you can play the middle, or you can play the last one, or you can play them all 3 on this type of a setup. You just need to have your risk and your stop loss set up, because you do not want to have no stop loss. Say if it gets to 10.50 and it bounces just a little bit and you're like, yay, but then it crashes back down to 9.50. Then you have your entire position stuck up here. You should be very happy by taking a loss of 3 cents with these type of risk versus reward setups. So there's 3 setups within this chart, totaling, if you got stopped out of all 3 and it just goes to crud, 6 cents or 9 cents per share total on 3 separate trades. So a lot of different value within this type of a setup. Let's move to the next chart. This is ticker symbol VAL, and I'd be very careful with a stock like this. One, it is very low priced, so it can move very quick. If you just look at the history of the chart, we went from 40 cents all the way up to $2.22 within 2 days. So if it can move up like that, it can move down like that. Now, when it gets overbought, we saw it pull down, right? And now it's moving into oversold territory, meaning that if it gets to oversold, we might see it start to move up. The overall context of this chart is bearish. So it's a bearish looking chart, but we're doing somewhat of a bullish type of trade. That's why I say be very careful with these type of setups. They can be rewarding, but yet they can destroy you as well if you're not managing your risk. So what do we got going on here? As you can see, we had a low of 30 cents on this candle right there, the recent candle. And then on this day right there, we also had a low of 30 cents. So 30 cents seems to be somewhat of a double bottom. And if you go back to the history of the chart, you see the same thing right here. So when it gets to 30 cents, typically it holds its floor right there. Now we have some decent volume pulling in comparative to the last few months of trading, or month and a half of trading, which is a good sign. However, this could be an indicator that we might potentially see a break of this 30 cents. So how would I go about trading this? If I look right here to the history of the chart, this candle right there looks like it broke about 40 cents. So when it broke above 40 cents, we really saw a short squeeze to the upside. So right here is 40 cents. We'll draw on the line. And then right here is support. So we have resistance and then we have support. Very tight little area. So what could you do? Well, you can speculate and you can buy shares between 30 and 40 cents and then have a stop loss at 29 cents or 28 cents, depending on your risk tolerance. That'd be one way to do it. That'd be the speculation. Or if we get a break above 40 cents and you want to enter in at 41 or 42, you can do that as well. However, sometimes if you wait, we might actually just potentially see a gap and go, which would then make this position irrelevant if you weren't able to get into the position. Now, typically a safe trader would wait for some sort of confirmation and break and more bullish momentum. Speculators would be entering in right around this range and then having a tight stop loss. Just know something that happened to me on ticker symbol MYT was very similar. It was a low price stock, had a good setup. Everything was looking pretty positive. There was some very bearish indicators, but news came out the other day and then it gapped way down, losing 22% on a single trade. Now you might be thinking, dang, that sucks. But really, because I manage my risk, that 22% only made me lose about $150 on that specific trade. So if you take losses, you should feel good about it. I feel really good about a stock that dropped 22% and I only lost $150. All right, let's go ahead and move to the next one. All right, here's ticker symbol GFF. Now this came up on the dark money scan as well. However, I didn't adjust the volume to have 5 million or more. So I want to make sure you understand that this is a little bit less of volume. Still, it's good liquidity, but typically it trades under a million, and that's not typically the type of stocks that I trade. Now, I don't have these gigantic, huge positions, so even 500,000 in volume would still be plenty liquid for me. However, we did see this massive spike up in volume, and the chart looks somewhat bullish. We had the context of the chart crossover here not too long ago. You had the 50 period sloping up, the 200 going sideways. That is the golden crossover, so it's bullish sentiment. We saw the run up, nice, but then we saw this pretty significant gap down. So the gap down was basically 22 bucks from 24, so a huge gap down. So you got to be careful on these type of moves. Gap downs can really wreck a portfolio. That's why I say you always have to manage risk. So Michael, why are you showing us this? Well, one, it's because of the huge volume. The RSI is not showing us much, but what I do like is how the price action is currently. We have a nice big hammer candle that formed right around $20.50. If you look back at the history of the chart, it clearly acted as resistance through here, and then it acted as support. Basically, what I'm thinking is we might see that bounce, that's the hammer, and we might see the bounce up to this 24 to close that gap. So how would I trade this? Well, I would just have a very tight stop loss underneath this candle. If the price wants to come down a little bit lower, I'd enter into shares here, have a tight stop loss, and then potentially look for the upside move to $24 as a target. That gap fill will act as resistance, so I probably would get rid of most of my position right then and there. I might mitigate some shares at $22.50 or $22.49 right here, and then I'd mitigate more here and then let the rest run for me. Overall, this chart does look like a decent setup, but you need to be very careful on this one. It's not particularly my favorite out of all of these, but it was still worth noting because it does look like it wants to kind of bounce from this point, but that 24 looks like just a hard resistance level, so we might go boom and then continuation to the downside, or we might just continue to break through that point. It's very possible. If you like these type of setups, good. Just make sure that you're managing your risk because this gap down right there is a pretty nasty one. Let's move to the next. Here's ticker symbol CXW. The context of this chart, bearish. Why is it bearish? Well, we have the 50 period moving down and the 200 period moving downwards. Now you need to keep this in mind because if you do enter into a long position here, you got to understand you're trying to swim up a river at this particular point in time on a breakout. Now the bullish signs here is that we have the MACD moving up, which is nice, a nice spread between the two. It's in bullish context. RSI isn't giving us much, and you have this somewhat of a bull flag taking place right here. So we got a couple bullish things happening in bearish context. So how would I go about trading this? Well, first off, the reason why I'm showing you this is because of the volume that has came into play. If this volume was not here, I would not be showing you this chart. The next thing is the price is clearly getting rejected by the 50 period moving average. If we get a break and a close above the 50 period moving average, we might see a continuation to the upside. Where can we go? Well, right here would be one specific area that I would keep an eye out for. $10.75. Clearly, it acted as resistance previously in the chart, so that would be one of my target areas. The next one would be this gap fill right around here at $11.70. Why would it be there? Well, that looks like a nice window spacing between here. Technically, from that specific day, it'd be up a little bit higher, but I still think that that would act as some sort of rejection up there. So what would you do to play this? Well, you can play it a couple of ways. This 950 looks like a good entry point. So if we do get the price to come back down to 951 to 955, I would say that'd be a good entry. Have a stop loss just below it at $9.48. And then you're potentially only risking about this much to earn that much, and potentially even more if it gets above it. Even if it didn't even get here, that is still a great 3-to-1 risk versus reward ratio. So that right there presents itself up as a good setup. Bearish context, okay? You got to remember the chart is saying that it's in bearish context. So bull flags sometimes break down in bearish context. That's why you need to have a stop loss. All right, let's go ahead and move to the next one. All right, here is ticker symbol SVM, Silver Corp Metals. This is, I believe, a mining company for silver. I love the miners, I really do. And really what we got going on here is just some nice consolidation. You can call this a bull flag, this nice run up right here, or you can call it an ascending triangle. I would call it more of an ascending triangle, I guess, or maybe even a symmetrical triangle. It doesn't matter what you call it. What matters is it does prepare itself for a good setup. Now, what's the overall context? 50 period above the 200, both sloping up very nicely. We have bullish context, a bullish pattern. The RSI, it's not overbought, not oversold. Healthy consolidation. The MACD, it's showing bearish, okay? So chart doesn't lie. It's showing bearish, moving slightly down. Kind of looks like the price action goes up, kind of comes down like that. But it's above zero. These bearish signs, if they're below zero, hold more weight. So you got to take that into consideration. Overall, how would I trade this? Being that I'm a fan of the precious metals, I would just be speculating within this channel right here and saying that I believe that the price is going to eventually break out above $8. $8 looks like a hard area to get through. It did it once, but then got rejected. So $8, a close above that would make this stock potentially go higher. Where would my stop loss be? My stop loss would simply be just underneath this trend line right here, or the low of this specific candle, and the low of that candle was at $7.43. So $7.39, I would say, would be a decent stop loss. If you want to give it more room, you can do that. I trade very tightly, so I would have it right there. I'd be entering in here, and I'd be looking for a breakout at least to $8.50. That would be my first target point. It reached $8.49, so I'd probably mitigate some shares at $8.49 and then let the rest run for me. All right, let's move to the last one. Here is ticker symbol INO. Now, I've been using this a few times on the weekly scan. The very first one was talking about this tightly coiled pattern, looking for a break to the upside or the downside. It broke down. Then the last one I was talking about was right here, saying that it was building a nice base around this 50-period moving average. And we said that if it broke below the 50-period moving average, we'd get stopped out, and potentially $16 would be a good entry point. Well, it reached right down there. If you would have entered in, you would have got stopped out right below that, so you would have lost on that specific trade. Why am I showing you this again? This looks like somewhat of a dead cat bounce. It looks like there's more downwards momentum. As you can see, it showed strength with this candle right here, then moved up, and now we have an inverted hammer taking place and got rejected at $16. So you have the 200 here, and it looks like the price might want to test that 200 period moving average. So this is actually more of a short play or buying a put type of play. And what I would do is I would have a very tight stop loss, because this thing could get away on you right here at $16.05. And I would try to enter in right around this range here to just below that candle right there. So I would have this as kind of what I'm risking right here. And then my potential reward would be down to the 200 period moving average. Now, if you're not familiar with buying puts or shorting certain equities, you need to be much more aggressive on the short side than the long side, because when you're shorting stocks, your risk is significantly more. So you need to be much more aggressive when you are approaching a stock like this. If you did that good risk versus reward trade right there and you got stopped out and you still were thinking that there's more downwards momentum, you could then look at $18 as potential another entry point to the short side. Depends on how the candle forms. If it is a nice hammer candle like that, an inverted hammer candle, then that would be all the more information that you need to potentially short and have a very tight stop loss again to potentially see more downwards momentum. So a couple good setups right here on INO from the short side. But like I said, tight stop losses on these type of moves, and be very aggressive with taking profits. Very aggressive taking profits, because this stock is very volatile. $26 on the y-axis to $28, that's $2 per share on a single move. So one candle, if it looks like this, and you bought 200 shares, that would be $200 in just a quick little move. And each one of these candles looks like it moves about $2 per share every single day. All right, everybody, that is all I have for you on this week's weekly scan. Good luck next week.